Welcome to Talk Tickers. Today, we're digging into the curious case of Dave & Buster's Q3 earnings. Now, on paper, the numbers looked like a pretty big miss, yet the stock absolutely soared. So let's break down exactly why that happened.
Okay, so here's the puzzle we're trying to solve. You had key metrics, things like revenue and same-store sales, that missed what Wall Street was expecting. Logically, you'd think the stock would have dropped, right? Well, instead, it rallied hard. The key to understanding this isn't in those headline numbers, but deep in the details of their conference call.
All right, first things first, let's just get the official numbers out of the way. This is what the market saw initially, and frankly, what caused all the confusion.
Now, there was one little bright spot here. Their adjusted earnings per share came in as a loss of $1.14, which, believe it or not, was slightly better than the consensus estimate of a $1.16 loss. A small win, but a win nonetheless. But on the flip side, total revenue definitely missed the mark. It came in at $448.2 million when the street was really looking for something north of $460 million.
And here's the other big one, comparable store sales. They also disappointed, falling 4%. That was a wider decline than the roughly 3.2% that analysts had penciled in. Not great.
So let's put it all together. You can see it right here in this table. Revenue and comp sales were both a clear miss against what everyone was expecting, only that adjusted EPS number managed a very narrow beat. On its face, this is not a report that should spark a rally, which is exactly why the story gets so interesting.
So to really understand why the stock rallied, we have to look past these headline numbers and listen to what management actually said. The new CEO laid out a really clear back-to-basics strategy that just completely changed the narrative.
And the plan, it centers on these 5 key pillars, all aimed at improving the fundamentals of the business. We're talking relaunching marketing, reinvigorating food and beverage, improving operations, refreshing the games, and revamping their store remodels. It's all about execution. And check this out, we're already seeing proof that the plan is actually working. As the CEO noted, the new menu they launched in October was a huge driver behind the food and beverage segment posting positive same-store sales. For them, this was a critical early win. And it wasn't just the menu. Management pointed to a whole bunch of other green shoots, as they call them. Everything from high-return games to much more efficient store remodels. The good news was starting to pile up. Okay, so this is where the narrative completely shifts. The market looked at that weak Q3 report, they heard about the turnaround plan, and then they found one specific data point to latch onto that changed everything. Here it is. This is the data point that lit a fire under the stock. That negative 4% comp for the quarter, well, that wasn't the full story. Management revealed that their sales trends improved every single month within the quarter. They finished the final month down only about 1%. The business was clearly and rapidly accelerating.
And you can literally see this change in thinking play out in real time right here. The initial reaction right after the report came out was, meh, pretty flat. But as investors started to digest that improving monthly trend overnight, the entire perception changed, and it changed dramatically. And this change of heart, it was absolutely backed by conviction. I mean, look at this. The trading volume on earnings day surged to more than double its 50-day average. People were putting their money where their mouth was. So with all that context, let's turn to our forward-looking thesis. This is what we here at Talk Tickers call the next call.
And this is really the million-dollar question, isn't it? The stock has been beaten down for a while now, but is this recent optimism actually justified?
So here's our take. We think the market has now priced in a lot of that optimism. For the next quarter, the big focus will be on proving that this near-flat comp trend is sustainable and not just a one-off. Because of this, we think the stock's probably going to be range-bound for a bit. That 12% pop, that was the hope trade. Now they need to deliver the results. And this all leads to our official rating. So we are initiating coverage with a market perform rating. At this point, the risk and the reward just feel pretty balanced as we wait for more solid proof points from this turnaround story. And the final thought we'll leave you with is this one. The clock is ticking. With their interest expense running at a hefty $40 million a quarter, these operational improvements need to translate into real cash flow. And you know what? They need to do it fast enough to outrun the company's pretty heavy debt load. That's the real race here.
This is not financial advice.